Hello, and welcome to the Restart Michigan webinar with UHY advisors discussing the topic PPP loan forgiveness and tax changes under the CARES Act. This is Marnita Harris. I'm the Director of Engagement with the Detroit Regional Chamber, and I would like to thank you all for joining this session. The Chamber has launched this series of webinars to help businesses across the state prepare to restart operations and return to work. I would like to thank our guest speakers from UHY Advisors for volunteering their valuable time to share their expertise with us. Before we get started, I want to make you aware that all participants are on mute, but you have the option to submit questions directly to the speakers through the GoToWebinar control panel. So there's a control panel on the side where you can enter your questions. I will now turn the webinar over to Tom Alongley from UHY Advisors.
Good morning and welcome. Again, we want to thank the Chamber for allowing us to present to the members on our program Restart Michigan. Obviously, this is a very timely topic. When we originally set the date for this program, we thought the final regulations would be out, but they are not. But we will continue to move through. We still have open questions, but we have a great program laid out for you to help you really guide you through this loan forgiveness process to help you maximize the amount of loan forgiveness. And if we have a few minutes, we will touch upon some of the tax provisions included in the CARES Act. Also on the line with us is Chad Kime, Managing Director in our Farmington Hills office, and Ali Badoun, a principal in our Farmington office. This is part of our team that is our COVID-19 response team that we've been very active from the very beginning of analyzing the act and for helping our clients through the application process, which we are now really moving into phase 2, as many of you have already received your loan fund, your funding from the program, but also, how do you, navigate through this 8-week period, this covered period, given the uncertainty surrounding when the state is going to open. The slide decks that we prepared for you have a lot of information on, and they were set up that way really to provide as a resource, as a guide, as you move through this covered period. Every company will be a little bit, timing will be a little bit different. So we want you to be able to use it to go back to. We have examples of our UHY tools that we have developed for our clients that help them plan and prepare for this process. Because there's a lot of questions, we understand. We're going to we have a limited amount of time, we're going to try to answer those. And we know there's a lot of questions that we'll talk about at the end that are open. So at this time, I am going to turn it over to Ali Badoun and Chad to move through the program, and I will chime in with some thoughts and points of interest as we move through. All right, thank you.
Morning, everyone. As Tom mentioned, the focus today is really on the forgiveness piece that's associated with the PPP loan. So we will not spend time covering the eligibility requirements. And where the forgiveness is going to start is really going to relate to understanding a lot of the terms that are being provided for by the law. And it's easy to say that we should be understanding the terms. However, as Tom mentioned, guidance has not yet been issued on a lot of these things. So a lot of this stuff is our best interpretation of some of these terms, trying to leverage where they've appeared previously, and trying to just make sure we kind of get some sort of framework, because people have been funded and their period for the forgiveness has started, so decisions have to be made, and based on that is kind of our approach to this presentation. It's important to understand as well the lender terms that came through the PPP. Different lenders had some variety of notes that they used, so understanding those and the complexity that comes with them is very important. A very big piece is planning. This is a time period where proactiveness is key, and so planning for the next 8 weeks is very important. We're going to walk through our tool in a little bit to show how kind of we've leveraged that. And then there's going to be the tracking piece that comes afterwards. So after you set your plan, once you start incurring all those expenses, it's very important to document those. Maybe consider using a separate bank account in order to create a very clear paper trail of what the money was spent on, because this money is going to be highly scrutinized when forgiveness is going to come about. And then obviously maintaining the supporting documentation for all the uses of the funds, including all the backup in a pretty accessible format, so that you're ready at the end of the 8-week period to go to your lender and present it and substantiate what it is that you're eligible for forgiveness for. So we're going to start with the terms that came through the Act, and these are some of the very key terms that's important for everybody to understand. One is being the covered period. That is the period that essentially is the 8-week period in which expenses that are incurred and paid are eligible for forgiveness. And that period starts on the date the loan is dispersed. So from the day you get your loan, you have 8 weeks to spend the money, and essentially during that 8 weeks, the pool of cost would be eligible for forgiveness. The second term is the notion of full-time equivalent. So this term was not defined within the Act, and as of yet, they have not issued any guidance on it. But where we've seen this before is through the Affordable Health Care Act that was enacted quite a few years back with the healthcare reform. And essentially there, you have employees that work over 30 hours a week or 130 hours per month. Anybody that works over that is considered to be full-time. And if people work under that 30 hours, they go into this pool that's then kind of divided by the 30 hours a week, and that gives you a full-time equivalent. So essentially, if you have 2 employees that each work 15 hours a week, that's a total of 30. Those 2 employees would count as 1 full-time equivalent. This is a very important term. It's very important to plan for it, because we're going to walk through some reductions that apply to meeting the full-time equivalent headcounts that came about with the Act. There's the full-time equivalent measurement periods. There's 2 measurement periods aside from the 8 weeks. One is February 15th, 2019 through June 30th, 2019, and then January 1st, 2020 to February 29th, 2020. The allowable uses. This is a very key element of this Act. Originally, it was allowed to be used, the funds were allowed to be used under the general guidelines of the SBA 7A section, which governs these type of loans. However, the rules and regulations that came out kind of seem to indicate that because of the finite appropriation, there's a focus on only using the funds for the intended purposes that have been specified within the Act. We break those out between 2 main buckets, one being payroll costs, and then we have the non-payroll cost bucket. So the payroll cost is the same definition throughout the Act. It's the same definition that was used in order to identify the average monthly amount to which the 2.5 times multiple applied to come up with the maximum loan amount. And that essentially is gross cash compensation, vacation, any separation pay. It includes health insurance, retirement plan contributions. Those are the employer portion of the retirement plan. So if there's an employer match or pension funding. And then we have state and local unemployment taxes that go into it. It does not include the following. So if you have any compensation for employees whose principal place of residence is outside of the United States. So an example is somebody who maybe comes from Canada, works here, and then but lives permanently in Canada, so they just come across every day. Those folks would be deemed to have a principal place of residence outside of the US. Their compensation does not count. It doesn't count any qualified sick leave pay or qualified family leave pay that is being reimbursed by the Coronavirus Relief Act that came about. So those are dollar for dollar reimbursement as payroll taxes that got instituted before the CARES Act. It does not include the employer portion of any employment taxes, such as FICA, so Social Security and Medicare. That's not allowed to be added. It does not include 1099 for independent contractors. And then finally, the payroll is capped at a prorated $100,000 per employee. So effectively, if we take that on a weekly basis, a maximum salary of $15,385 is allowed per employee. We have a slide just on that coming up. The non-payroll tax bucket is comprised of 4 elements. One is interest on mortgage obligation. According to the Act, it includes real property and personal property, and principal paydowns are not allowable, so it's just the interest portion. Rent payments, which is just simply defined as rents under a lease agreement. So the Act does not specify whether these rent payments apply to personal property or only to real property. You know, the only reference to personal property comes with the language that's involved in mortgages. So really guidance is needed to be able to identify whether if you have equipment lease payments, those would qualify to be used. It could go either way, frankly. Our recommendation is, depending on a position that somebody would take, always be ready to know that if for example, personal property does not get counted, that, you know, what does that do to your cash flow if that does not get forgiven, so that you can at least quantify whichever way kind of the coin would fall based on the ultimate guidance that comes out. Utility payments, so this includes electricity, gas, water, telephone, internet, and transportation. We've been getting a lot of inquiries about, you know, with people working remote, stuff like GoToWebinars and stuff like that, or Google Voice or any of that stuff, Zoom. We believe that that would fall between telephone and internet access. It should count. Transportation is an undefined term, really a question mark. We're just looking at that as transportation in the sense of utility transportation, some pipeline stuff, that type of expense, not related to like transportation in the sense of vehicle related. So until guidance comes about. And then the last piece is really interest on any other debt indebtedness that was incurred before February 15th. It's important to note that this one, while allowed as a PPP allowable use, is not eligible for forgiveness. And so you can use the money to pay your line of credit interest, for example. However, that expense is not going to go into the pool that would be eligible to be forgiven. Okay. The importance of kind of delineating payroll cost and non-payroll cost is because when it comes to forgiveness, not more than 25% of the amount that's forgiven can be attributable to these non-payroll costs. So effectively, what the rules are saying is that they are going to allow for forgiveness to be 75% payroll, 25% non-payroll, because the whole intent of this program is to fund payroll and paychecks to the employees. Their rationale behind the 75-25 split is we're advancing people 2.5 times average payroll cost. We expect that to last 2 months worth of payroll, so that's 2, and then that half is what covers the other expenses, and therefore 75% of it is on payroll, 25% of it is non-payroll related.
Okay, so we wanted to put together an example for people to look, for you guys to look through, and so we have our tracker here, which is a budget tool and a tracker at the same time. So here we have Famous People Inc. They received their loan on 4/15. So then we walk through their payroll costs, and as Ali described, gross wages, you can see that they pay on a weekly basis, $19,600 per week. We have our health insurance costs, which go into our payroll costs. state unemployment taxes, and then employer retired benefits, 401k match, pension plan. Again, there's been no guidance as to that last part of the 401k match or the pension plan contribution. If we have a big profit sharing match for payroll in 2019, do we get to pay it in this 8-week period and get credit for it? We don't know. So we roll through with those costs, and then we have our subtractions, right? So that's the qualified sick leave or family leave pay from the newly enacted Coronavirus Act, employees that have a principal residence outside the U.S., and then our $100,000 proration cap on wages. And so that is just on gross wages. It doesn't involve a calculation with health insurance or unemployment taxes or anything like that. So we get our total of payroll costs that we've incurred. As you can see by the side, we went a step further and said, hey, this is our total, and then this is our percent of total cost. So we want to make sure we're monitoring that 75% limit. So we roll down and we have interest on mortgage obligations. In this case, we rent. So we have our rent. And there's questions as to whether it goes back to the profit sharing, whether back rent, we're allowed to pay back rent or prepay rent. All the excess incurred and paid, we kind of take that reading to say you're probably going to get 2 months of payments. You have an 8-week term. You're probably going to get 2 months of payments of rent and utilities. So we roll down with our utilities, and we have essentially our subtotal payroll costs and our subtotal non-payroll costs, right? And that gets us our total. So now we can monitor the percent, whether we're close to the 75% or we're not. And so then down at the bottom, our maximum forgiveness is basically the cost we pay or our payroll cost divided by 75%. So in this case, our total cost that we paid was less than 75% payroll cost. So that gets us our total of $153,542 in this example.
Just one thing I would like to add on that, Chad, just one thing on that is, maximizing that payroll. We know that some are kind of struggling or dealing with, how do I maximize that 75%? We're closed, we're not going back to work yet. During this 8-week period, the governor's extended the shutdown. We do think there's a lot of discussion regarding extending the 8-week period, but it's not been finalized. They understand the issue. It's been just discussed quite a bit. So we think there could be some movement there. But other things we're getting, obviously questions on is that, you're competing against unemployment in some cases. And, we believe in everything we can see is that, potential like a hazard pay or additional increases during this covered period to get employees back to work seems to be okay under the current act as it's written. So those are a couple of things to consider. We're really hopeful that this 8-week period may get extended out because we understand, not all businesses are open.
Well, it's on the other thing that we need a little bit of clarification on, as well as this incurred and paid. A lot of you are asking the question is, we don't know if you ramp up and get your payroll back on and you say you have a week holdback, do you have to try to accelerate to make up for that week and get the cash paid within this 8-week period so you get credit for the payroll rather than, I don't know if you want to say accrual-based accounting where the payroll started within this 8-week period, or I paid it within the 8-week period. So we really need some clarification on that.
A couple of points on those two elements. In terms of kind of increasing the wages, I think it's important, while the act does not preclude from doing so when you're competing with unemployment, I think everything has to be done within reason and has to have a justifiable business purpose because these loans will be scrutinized. So if it's understandable why certain decisions have been made, I think that those will stand scrutiny. But if it's just kind of unilaterally to just increase wages for 2 employees out of the rest, just to get the PPP money going one way, I think that would be looked at problematically if challenged. So I think everything has to be documented within a business reason. And why was it necessary to all of a sudden increase wages in an 8-week period? Kind of like Tom mentioned, hazard pay. These are people that are actually working. They're coming into work compared to somebody who may be getting paid not coming into work, and therefore they command a higher wage during this time period than others. And then to Chad's point on the incurred and paid, I would highly recommend for everybody to plan on what would be a special payroll at the end of the 8-week period look like, and have a game plan to potentially run that until guidance come about. Because if it's important that it's both incurred and paid within the 8-week period, you want to capture those days that could otherwise fall into a payroll that is outside of the 8-week period, and all of a sudden they don't count because they just weren't paid. So I would encourage you, talk to your HR department and say, what would it look like if, in this case, June 10th is my ending period? If I were to run a payroll on that day or the day before to capture all those days up to that point, what would be a game plan until we get some guidance as to how they're going to look at payroll in that sense. So.
Okay, so there's a lot of questions surrounding this $100,000 proration cap, and so all the act says is that essentially they get to this $15,384.62, which is $100,000 divided by 52 times 8, and they say you can't pay an employee more than that amount of money within this 8-week period. So in our example, we just wanted to show kind of how that would work. The question is, if say Johnny Carson was unemployed or laid off, furloughed, and I brought him back in week 5, could I pay him the $15,384 in 4 weeks, in the remaining 4 weeks that I have? We don't know. We don't know. There haven't been guidance for that. So basically what they do is they just threw out the $15,384.62 number, and that's what we have to look at. So here we're just looking at on a weekly basis, since we're a weekly payer, what our non-allowed compensation is versus what's allowed. So anybody who ticks over that $15,384.62 would not be allowed. And the other thing that they haven't really touched on is the prorated part of, if, say, like Ali mentioned, you want to pay hazard pay or maybe have a bonus in this 8-week period. We're not sure how they're going to look at that through the 8-week period if the bonus is going to all of a sudden throw off this calculation. So this is how right now we're looking at the $100,000 proration.
All right, so after you've developed the pool of expenses that's eligible for forgiveness, which is what we just kind of went through, then there is a couple of reductions that have to be analyzed in order to determine what is the amount that's actually ultimately going to get forgiven. And so there's 2 types of reduction that will apply. We'll start with the number of employees. And this is where this concept of full-time equivalent comes about. And so what the intent here is, we're trying to kind of quantify how many full-time equivalents did the company have in one of 2 periods, which is February 15, 2019 through June 30th, 2019, or January 1st, 2020 through February 29th, 2020. And it's at the borrower's election to choose. So we choose the lesser of the 2 because that's our denominator. And then what you have to do is you have to look at what your FTE count is in the 8-week covered period. And you compare those 2 numbers. And if there's a reduction, then depending on what the percentage reduction in those numbers, you will get a corresponding reduction in the amount that you are going to get forgiven. And so one item that is important to note here, that employees that were laid off because of the issue of unemployment, if the employer tried to bring them back and they've documented that they've put in a good faith effort in doing so, which is yet to be determined of exactly what documentation the SBA is going to request, those will not count against you in terms of FTE reduction. So while you really couldn't get the employee back, it won't get into this calculation for you, but more guidance is needed on exactly how they're gonna look at that.
So here we continue with our famous people Inc. As you can see, the loan date was 4/15, so we come down and we look at our covered period, right? And so we go back, our average number of full-time equivalents during the covered period was 10. So we saw that from our payroll report, right? We had 10 people. And so now we go down to the first period we look at is February 15th of 2019 to June 30th of 2019. And we look at what our FTEs were during that period. And then we go down and we look at what our FTEs were during January 1 of 2020 or January 29th of 2020. So, or February 29th of 2020. And then the other thing is that they have different rules for seasonal employees. And so if you're considered a seasonal employee, you may want to dig in that a little bit, but you would use number 2 because essentially that's when in Michigan at least, or around the nation, the seasonal employee issues would be there. So we go down and we say, what's the lesser of those two and 3, which is 12. And so we essentially hired up or had employed 83.33% of our FTEs from those 2 periods.
So in that case, you can expect that your eligible forgiveness is going to get reduced by 16.67% in because of this reduction. The second reduction that's out there is a salary and wage reduction. In this case, essentially, if there's any employee that's paid during the covered period whose salary and wage has been reduced by more than 25% compared to their wage in the first quarter, then the loan forgiveness will get reduced dollar for dollar by that excess over the 25%. Okay. The act is very poorly written in this particular section because it talks about a total wage of an employee for the 8-week period compared to their total wage during that quarter. So now you're comparing an 8-week period to a 13-week period of pay, and that's gonna come up with a result that's more than a 25% reduction, even though the employee could be getting paid the same rate and the same hours. And so our interpretation, until further guidance comes up, is more of a kind of a average per pay period is what they're gonna ultimately look at and make sure that employees are getting paid, relatively the same in terms of number of hours or pay rate for those pay periods, and that's how they're going to apply, and then maybe extrapolate, and that's how they're going to apply this type of reduction. And so it's important to note here that there's a couple of things to keep in mind, that even if you didn't reduce the pay rate of a particular employee, if you've dropped down their hours or they were working a lot of overtime, under this interpretation, this will affect potentially the calculation of the loan forgiveness, right? Because the idea is you borrowed based on them working overtime, but you didn't pay them that overtime, and that's their true up mechanism per se. So
again, we put this together. If we go back, we have our wages during the covered period, right? So this is what we paid during the 8-week period. And now, as Ali mentioned, when you're looking at this and you have to look at, you're trying to plan for this, you can kind of look at B if you want to look, and you say, okay, I'm going to take my total wage per my last quarterly payroll, right? Which we're looking at is your first quarter MESC report, something that shows the gross wages, unemployment report. And so you take, and there's 13 payrolls in that report if we're reporting weekly. So I get my average, and so then I can work back in column A here and look at that and plan for if I'm going to reduce pay or what that reduction looks like. So I take my total wages per the covered period, my number of payrolls that I had in that covered period, that's giving me my average, and then I compare it to my last quarter, right? And so if anything's over that 25% threshold, that reduction, I get dinged. And so basically, as Ali mentioned, we looked at this as an average. Now, obviously, the law reads differently, but we looked at this average. So we come over and we get the excess over our allowed reduction, then we have to multiply it out by the number of pays. And so this is our total reduction for salaries, and this is a dollar for dollar reduction. But again, I think our sheet kind of allows you to plan so you can understand where you have to work back from. If you take that first quarter UIA report, you can look and see what you're at, and then you can work backwards from there.
And
yeah, just one quick question. Obviously, the biggest issue here is really we're comparing 8 weeks to a prior quarter, which is 12 weeks, as I mentioned. And, you know, that's where we're still waiting for some final clarification on the act here.
One item to note also on this is that employees who made over $100,000 in 2019 are exempted from this type of testing. So if you've reduced employees who are making over $100,000 by more than 25% of their cut, that's not going to affect your forgiveness. Exemptions. So the Act has a couple of exemptions in place currently that also definitely need a lot of guidance on. One is a rehire exemption, and then the other is the restoration and salary. And so the rehire exemption seems to read in a way that indicates that those FTE reductions that we talked about in the first kind of number of employee reduction that we went through, if by June 30th, the headcount compared, has been restored to the same level that it was on February 15th, 2020, then it seems like that reduction will not apply. So you calculate the reduction, you see if you have some sort of a reduction that you can expect from your forgiveness, but then they seem to be giving employers up to June 30th to really remedy and get their employees back. And if they manage to do that, then they're going to say, okay, while you're only at 83% in our example, we're not going to apply that reduction because by June 30th you fix it. The question here, the open-ended question is, do they really mean that you have till June 30th, or are they saying not later than June 30th, but they mean that you have to do it within your 8-week period, right? There's no guidance, so it's really tough to tell anybody, hey, you have till June 30th to fix some of these things. The idea is employers should be working towards getting that FTE headcount up as fast as possible because that is an average within the 8-week period, right? So it's every pay period within the 8 weeks, you got to count your FTEs, and then you're going to take the average of all of those pay periods. So if you wait till a later part to hire your employees, one, you won't get the you will not get the FTE count up, but also you will not spend enough payroll costs to get that pool of eligible forgivable expenses. The second one is the restoration of salaries that we just also went through. Is if by June 30th there was a shortfall that was since fixed, then that reduction will not apply. Mechanically, that's going to be a tough one. I'm not sure how they're going to come and be able to kind of test that, hey, by June 30th you fixed a shortfall, if it's based on an average, or unless they come up with some different mechanics to look at this. So just note there are those two exemptions out there, but they're very, very vague in terms of how they exactly going to work. But there seem to be some sort of relief that's going to come in from applying those two reductions if certain conditions have been met.
Okay, so let's run through our summary and just kind of look through it. So we saw the top part. So we calculate our FTEs during the 8-week period, and we calculate our 2 periods, and we got a reduction of 16%. So we rolled out and we had a $180,000 loan, and from our qualified expenses that we put in, we had $153,000 of qualified expenses in the 8-week period. And then we have our reduction, right? And so that 16% reduction in number one there, 25,590 is 16% of the 153,542. So the reduction comes off of not the loan amount, but the expenses incurred and the amount of forgiveness. And then we had a small reduction for the salary. So we had $2,200 of a reduction there. And we come down and we say our net allowed expenses is $125,752. And so that's our maximum loan forgiveness. And then we have a loan balance after forgiveness of 54,248. The question out there that hasn't been cleared up, especially with the additional certifications that the SBA is requiring, is my loan actually really 153,542 and less the 27,790. So my loan is actually 27,790, and I have to return the difference between what I didn't spend and what I got as a loan, and then I have the loan for forgiveness sake. We just don't know with companies getting these big loans and then maybe not spending all of that and having large balances out there. We're not sure how that looks, but right now, the way the act reads, this is how our sheet was set up.
Yeah, and that's a big item there that as the state shutdowns have continued on here, is the balancing of bringing employees back with no revenues. And that's why we're really hopeful that the 8-week period is extended so employers can use those proceeds once they start back up for payroll. And that it is, yeah, there's lots of rumors out there that the money's going to have to be given back that's not used, but we have not seen that in any loan documents that some clients have signed, but again, it's subject to further clarification by the Treasury.
Right, and those are some of the questions. Here's a kind of a list also of some other questions that are out there that really need to be answered in order for people to kind of make better decisions given the funds that they're going to be receiving. We've talked about the concept of cost incurred versus costs paid, the definition of FTEs. How much are they going to allow us to include in utilities? What do they mean by transportation cost? These reductions and how they'll apply, especially also with the exemptions and how those would be final rules surrounding those. The $100,000 limitation in terms of is it kind of some number that's going to be prorated based on when you bring people back to work? So if you hire somebody, as Chad mentioned, halfway through, is that 15,000 really 7,000 now that you can spend, or can you still give them the 15,385? The 8-week period is a big one with there's a lot of restaurants, hair salons, many other businesses that are still completely shut down. They cannot bring their employees back. They've received their money, and so how long are they going to allow them to hold on to that money and then use it in a way where it becomes forgivable versus it become a loan is a big question mark. And if you didn't use the money, in our example, you have $180,000 loan, you use 153 of it. So we got that excess, and is that going to have to be repaid when you go in for forgiveness, or do you get 2 years 1%? So another key item that is currently out there, essentially that's been getting a lot of press. This started with Shake Shack getting money and then having to return it because of bad PR, is this concept of the certifications that the current economic uncertainty makes this loan request necessary to support the ongoing operation. The FAQ that the SBA has issued seems to indicate that you have to make this obviously in good faith, and that if you have access to other sources of liquidity, you might be precluded from being able to make this certification. And then the Secretary of Treasury came out and said loans over $2 million will automatically be audited. Originally, it was seen to be leaning towards public companies, but they emphasized that private companies are equally have to adhere to this and look at this. So it's important for any company that's received this money to assess that they've met the conditions under this certification. They have till now May 14th to return the funds, and if they do so under a safe harbor rule, they will not get penalized should they have failed to kind of meet the certification here. So from our perspective, as we kind of get a little bit to the end of the presentation, just based on time, we just want to kind of leave you with some final thoughts. Again, this all comes back to budgeting and preparing for the next 8 weeks. So when you receive your money, you have to have an 8-week forecast. You have to identify those FTEs for the measurement period. You have to quantify how many people you're going to bring back and what does that do for your loan forgiveness. Because if you don't get those ratios right, you'll find yourself spending that money, and then not all of the money ends up being eligible for forgiveness. So while you spent it, you end up with a loan that you have to repay. So essentially you end up spending your own cash rather than fully the PPP money that would be eligible to be a grant. Establishing a separate bank account, it's not required by the law, it's just kind of best practices to keep the money segregated, again, so you can create a very clean paper trail and allow somebody to easily audit if they want these expenses without having any trouble, and you can substantiate that you've only used it on allowed uses and that there's nothing there to worry about. Getting the employee for the first quarter for the salary reduction, also that allows you to plan how much you can pay an employee, how little you can pay them, or how much you can kind of restore them, especially employees who had kind of variable comp, as we mentioned, because of overtime hours or stuff like that. Allows you to maybe try to make up some of that money during the 8-week period using PPP funds, and then you estimate your reductions. And then documentation is big. Having a clean and organized tracking sheet with sufficient details for somebody to be able to simply just stick and tie it and make sure that it's got all the necessary information to substantiate the forgiveness is very important. Doing that on a weekly basis, don't wait till the end of the 8-week period to kind of accumulate all that data, is very, very important. And so, one last consideration on the tax implications that come with the PPP. As the PPP was issued, we had the income was not going to be taxable, so it was excluded from being included in taxable income. But the IRS recently came out with some guidance that said that while the income is not taxable, the expenses that are paid using PPP money are no longer deductible. So now it's a wash. You don't get the expenses, but you don't get hurt with the income that is forgiven. But originally we had thought that hopefully the expenses paid would still be qualified as a tax deductible item, so that really gives an extra boost for companies. It's important to note there's a lot of bills that are being thrown out in Congress because they're saying that that wasn't the congressional intent of this bill. So maybe something gained some traction and the deductibility expenses will go back while the income is excluded. But as of now, the expenses are out. So we have a few minutes left. We probably won't be able to get into our tax slides that we originally planned for. Much rather probably just do some conclusion here, Tom, on and then try to answer maybe some questions that came about if we can.
Yeah, we have a lot of questions. I've been trying to answer a few as we've been going through. Apologize, we know this is a very hot topic and maybe we'll need to do a follow-on presentation as the final regs come out, but we wanted to give a baseline, obviously, for everyone to work through. And the question around the certification, and that is a big one for those that maybe have the wherewithal to weather the storm. But again, we're encouraging our clients to document obviously the impact from the coronavirus on their business and their liquidity and sources of capital. But this phase of the PPP program is really, for many, it will be a Band-Aid. For some, it will be a bridge. But we do realize that, we look at our practice. We're here to help, guide you through, the loan forgiveness documentation with our UHY tools. But most importantly, as I look through and the team looks forward, is, what's the next steps here? The banks, we made it through Q1. We're moving into Q2. Going to have probably quite a few covenant violations in Q2 and maybe Q3, depending on when things get turned around. So lenders are going to be looking for 13-week cash flow or monthly modeling, and really have to understand what additional liquidity you may need. There's additional Main Street loan program that was just rolled out by the Treasury that could be another bridge. It's probably not going to be as widely used as the PPP program, there's a lot of more strings attached to it, but that could be a source. So helping with working capital analysis, looking at obviously lender and sources of capital could be very, very important. And obviously it's something we've been talking about for many years is, are you a consolidator or are you a target for consolidation? This COVID could accelerate some of those companies thinking about other options. And we're hoping that, the option isn't a bankruptcy or a liquidation. So what other options are out there to avoid that type of, outcome? We are very, very hopeful that there's a lot of pent-up demand and these businesses can survive and thrive. But we know for some, the expedited M&A type process may be something that is needed. Not only there's a lot of dry powder and people looking for acquisitions, but also those that are, potentially looking for additional, financial strength to merge into. So as we look forward, there are options. We want to make sure that that there's help out there, and our team is ready to support each one of you as you move forward over these coming months. Our contact information is available. Also, you will find, if you visit www.uhy-us.com, you will find on our very landing page our COVID-19 response that has all the new information has been coming out. We've been providing that information on our website to keep everybody up to date. This is a very fluid situation. Again, we would like to have had all the final regs available, but we're working with the information that we have in front of us. I know we have a lot of questions. I've tried to answer some. I know we're a minute over. Chad or Ali, should we tackle a few of these? I know a lot of them I can see are dealing with that. The comparison on the salary reduction, the 8 weeks to the 12 weeks. And that's something that we know is a question out there.
Yep, that's why we're taking the average approach. And then I think there, I would say that it's something to look at who you paid during the 8 weeks and compare them to what they got paid in the Q1. If somebody was in the first quarter but didn't get paid in the 8 weeks, we believe that's not going to hurt you because that's already being factored into your FTE reduction. And so there will be no double dip. And then it's important on the FTE side, you can rehire other employees. You don't have to rehire the same employees. It's just a number, not the exact same people that are requiring you to hire. So.
Yeah.
Okay. This is Marnita Harris from the Chamber, and I'm here to wrap up today's discussion. I would like to thank the UHY advisors team for their time and this valuable information. To all the participants, I would like to thank you for your time today. You will soon receive an email from me with a link to today's discussion in case you want to review any of the information shared. The email will also include today's materials. Please visit our website at detroitchamber.com/COVID-19 for the upcoming schedules for Restart Michigan webinars and our teletown halls as well. We will be providing more valuable information and data to help your business return to work. And I just thank again the UHY advisors team. This is just great information that we all know we need right now. So thank you all for attending, and we will continue to provide information for businesses in Michigan. Thanks so much.
Thank you.
Thank you.
Thank you.